The next cluster we're going to focus on are investment strategies.
And we're not going to go into every investment strategy, but we are going to go into some that you may have heard. The first one is dollar cost averaging. This is where you invest the same amount over regular intervals of time. And what happens is, as I told you earlier, the stock price changes, it goes up and down. But if you're investing the same amount over a period of time, then you're averaging out what that stock price is. For instance, if a stock costs $5 one day, $10 the next day, and $10 the third day, then if you were to sell that stock on the fourth day, your total cost that you have in that stock is $8.33 per share. So if you would sell it for that $10, you would actually make a profit. Diversification is the next term. This is the classic term where they say don't put all your eggs in one basket. They're saying don't just buy one stock and put all your money and all your funds in that one stock. Instead, invest across multiple companies and maybe even multiple industries. I like diversification. For me may mean tech as well as financial or as well as other companies, real estate, for instance. That kind of diversifies. And what that does is if, let's say, tech is going down or tech is hit real hard over a quarter or over a long period of time, you're not going to suffer everything because you have other investments in other industries. The next term is blue chip stocks. This is like the large, well-established companies that have a long history of performance. These are oftentimes what they may consider safe investments. They grow. They're established. These are companies like IBM or Microsoft or John Deere. These companies have been well established, have a long track record, somewhat safer than maybe some of the newer companies or some of the international companies. The next term is risk versus reward. Every investment has a trade-off. Safer investments grow slower and riskier investments may grow faster, but you could lose money. So understanding that balance and what works for you is the best thing. Let me say this. Investing is an emotionless game. You cannot bring emotions into your investments. Otherwise, you're going to have a very tough time selling. You're going to have a very tough time when things don't work out the way you had hoped. So ensure that you leave emotions at the door and that you focus on fundamentals and focus on what your strategy is.